All right, Luke, not too long of an overview this week. I just came back from surgery, and so I'm not too beautiful for you to look at, which I obviously normally am. But we're also talking to Michael Gentile, and so we don't have too much time before he gets into the room. So let's just maybe quickly go through the list of movers of last week. And I'm seeing there's almost a 3x here, but it's purple. The ticker symbol is purple, so I suppose that means London. I see volume, $8 million of volume, pushed this stock to an $80 million market cap. So it's a 176% again, almost a 3x. But the interesting part is that this was $1 billion company, 1 billion with a B. And oh, it had Russian assets. Now I get it. Okay, yeah, take it away. What's happening? Why is this a $1 billion company? Then it was less, and now $8 million of volume. It's interesting. What's happening?
Yeah, you already told us the story, so we can go to the next one.
Okay, let's go to
No,
Michael Gentile. No, I'm kidding.
no, yeah, you're right. Eurasia Mining. I'm not following the London companies very closely, but I do every morning check the news. I didn't even notice this one because there was no news, but there was a share price increase, which I nowadays track per exchange. That's why you see the colors. Orange are Canadian stocks, blue Australian, purple, London, and red, US. So this London stock was number one this week, and 18 million market cap, up 200%. What happened? I looked into it. No news. Last corporate presentation from 2021, and that's why when you start to become interested, like no news at all, no presentation at all. What happened? Well, they did have one news release, but there was a statement regarding the share price move. The exchange asked them to explain why the stock was suddenly moving, and they were referring to online speculation that a definitive feasibility study for their project in Norway, in Russia,
Same thing.
is coming up. Yeah, yeah. So they reiterated that the DFS was completed in 2023, and that no material developments regarding the DFS since the last announcement have happened. I didn't really look into the DFS because I feel like there may be a different reason. They end this statement with primary focus of company remains possible sale of Russian projects, although no assurance that something like this will happen. And then you look into those projects, and actually they own some pretty impressive nickel PGE type projects. One that's in production, and one that's really big, and I think even very close to Norilsk. It is a really what they call scalable project, and I didn't even go into too much of detail, but it is they have a number of projects. I think 4 projects within Russia, and in 2022, when Russia invaded Ukraine, all these Russian-related stocks went down, and I saw a lot of them on the London exchanges, including Norilsk and Gazprom. And I actually bought one just before the invasion, which was a company called Amur Minerals, because they were also about to sell their Russian project, which was rumored already for quite a while. And I was in that stock when Russia invaded, and the stock completely crashed. And this company I didn't really notice before, but also this company came down from a $1 billion market cap. It was trading at about 40. I guess it's 0.4 pounds and 40 pence. And it came down to all the way to whatever two or something, and it doubled or tripled last week on no news really. So my guess is that they are about to sell their Russian projects, and since they are pretty impressive, yeah, what is somewhat? I mean, it's gonna be a Russian buyer for sure. I'm not sure how many regulatory approvals they need to sell their projects, or maybe it's encouraged for UK companies to get rid of those projects. So they are certainly not going to get the maximum value out of it, but they were worth $1 billion. They recently were worth only, what is it, 50 million or so, 40 million. So, maybe they can get a couple of hundred million for these projects, and somebody in Russia is going to be very happy with it. So that's the first thing I noticed. Again, it's a bit of speculation. We cannot talk about it too much because it's all guesswork. But if a company goes up on 8 million US dollar of volume, then and it moves to an 80 million market cap from being a 30 or 40 million or maybe 20 million market cap, then something is going on, I guess.
Is there an angle though? Like, why are you even telling me this? What do I do with this?
Well, I don't think there's really an investment angle. I wouldn't buy this at this level, even if there may be more upside because there's potentially a sale upcoming. This other company which I owned, Eurasia Minerals, they ultimately sold their project, got a bit of cash for it, and now they changed their name, changed their focus. They became a pharmaceuticals company. They got a new board. So maybe this company will sell out, get a lot of cash for it, becomes a sort of a cash shell, and will start new business. And of course, that's also tricky because when it gets new business, maybe you don't like that business and you don't want to be part of it. Ideally, of course, they sell it and they then just distribute the cash to shareholders, with the downside of probably you paying tax on that dividend. So I just find these events interesting because it's the biggest mining mover of the week, and I think it will lead to something potentially. Yeah, a cash sale, and we'll see what this company is going to do with that cash. Are they staying in the mining game if all of this happens, or are they just gonna distribute that cash? And again, I'm speculating. I'm not sure if this is gonna happen. I just think it's interesting that the company goes up on no news, on volume with Russian projects right now.
Hmm. Yeah, value creation. We know all about that in the junior mining space, which actually reminds me of the next story that you have on here. It's even better because it's a typical junior success story. It's a stock that went from a high of 25 cents in 2019 to um, another great high of 1 cent a week ago. So it went to sub $1 million market cap, I believe, like 1 million market cap. And now this week it went to 2.5 cents, which kind of reminds me of that one meme that it's the third place celebration meme. But it's now basically being taken over for $9 million worth of Miata shares, and I wish those were 9 Mazda Miatas. They're a little bit more fun than shares. But so yeah, again, it's pretty much the story here. I told it again, but it's a mover, I guess. But again, why do you have it in the list? Like, is there an angle with these things?
Yeah, well, it shows that I mean sometimes we are fishing in those 1 to 5 million market cap companies, and this one you could argue 2 weeks ago you could have argued like, hey, this is only $1 million stock at 1 cent, with still a pretty decent share count, you could argue, and a pretty interesting project. I mean, they drilled um, 380 grams gold over 1.5 meters a couple of years ago, and they have channel samples like 14 grams over 9 meters in Suriname. And they are getting 9 million shares of Miata, by the way, not $9 million. But so you have this company being listed already for a number of years, and could be seen as an opportunity in this sort of market that is getting back into favor. And you think, oh, let me buy some of those $1 or $2 million companies who will just go up 3 or 4x just because the market improves. But then this happens.
Hmm.
Another company, Miata, is taking them over. Never heard of them, which is just a cash shell, or not just a shell actually, listed last year with a couple, with a very tightly held share structure, because you can see there's almost no liquidity. Stock is pretty strong. This was trading at 20, 30 cents, moved up a little bit before this happened, this news. And at that increased share price, they announced this deal where they buy 79 North for 9 million shares. So as a 79 North shareholder, now you will be depending on this Miata team that nobody ever heard of, making your 9 million shares worth something. And maybe it's a good outcome because it was a 1 cent stock going nowhere, and now you get shares of probably a company that is just getting started, and everything then depends on the Miata people behind it. I didn't go as far to really dive deep into their histories, but it shows again that if you're fishing in that $1 to $5 million market cap range of companies that completely failed, sometimes you can be lucky and you can really get your 5 or 10 bagger just because it was so cheap. In this case, you get your small premium over that 1 cent share price, but now everything is depending on the next team within Miata if they can make your 9 million shares worth something. So this is the second biggest mover of today, of this week and last week. and that's why we cover these two stocks. Both of them, yeah, to be seen whether or not it's going to be a big success in the future. But both of them being the biggest movers, and that being the topic, interested me to figure out what was happening.
When I ask if there's an angle or a play here, what I mean by that is like, can I do like, because this almost sounds like free money, which is of course silly to see, which makes me think like, what's the catch? Because so for these 9 million shares that you're getting from Miata, they're 44 cents. That's about a $4 million valuation. There are about 100 million shares outstanding of 79 North, 4 cents a share. Stock is trading at 2.5 cents. What's the catch? I mean, the
Well,
delta between those two.
the
Yeah.
the paper, if this company, this Miata, was started last year, and when a company is created, typically the people creating the company get a number of million shares for $20,000. So they get a lot of stock in the company for little money. So their average investment level is then 1 or sometimes less than 1 cent, sometimes 5 cents. And then they go public with often a qualifying project. So they have a project. In most cases, the project doesn't mean much. Sometimes it does, but it's just a way to get public. And you need a project to be qualified and to be a real company, and not immediately be a .h company when you are a company without a project. And then these companies start looking for projects. In this case, they found 79 North, and I guess that the Miata shareholders, the small, probably, I guess that 80% of the shares are held within 20 or 30 people, maybe even 10 people. But they still had 250 people to get listed. So those people probably only have a little bit of stock. So that's why you see almost no selling. Share price very stable at 20 or 30 cents. So they have a pretty decent market cap for what they really have, which is nothing, almost nothing. And with that paper, that's almost just paper. It almost doesn't mean much. There's no intrinsic value behind the 30 or 40 cents other than the people behind it. And that's why the people are crucial at the Miata side, like to show like why would 79 North take 30-cent paper? That paper has no intrinsic value at all, except for the people behind the story. And so you're really depending on that paper. And if you're unlucky, the 79 North shareholders will sell the 9 million shares immediately, and the Miata stock is going to 5 cents. I don't think that will happen because I guess these people have thought about it, how to deal with this. But it's crucial to understand when you buy a company like 79 North to play the arbitrage, to know who are the people behind Miata, and do I think that those guys can really make this project worthwhile? Because 79 North obviously couldn't, because they went to 1 cent. From 25 cents, they went to 1 cent. So people lost almost all their money if they bought at that level. And now it's up to Miata to create value from this 30-cent level, because 30 cent is the financing level. I guess is this level where the deal was done at, but the share price is at 45 right now
Hmm.
to make it sort of look interesting to the new shareholders.
I like these examples because they show you how things can move, just like this Miata that just like the next company we have in the list too. Seems like I've planned this. I didn't, but the next company we have in the list here went from $17 just a couple of years ago, 3 years ago, to 50 cents
Yep.
just last
Yep.
week. It's doubled now, but it says carbon streaming, so that's almost on the ignore, almost immediately on the ignore list for me. You have it on here. What's happening?
Yeah, I completely missed this one, unfortunately, because they came with news on a Friday evening, and companies always do it on purpose. So I think they did it on purpose. Maybe they didn't want the promotional side of the news release. Um, this company was created, and Americ Gattusa was part of that early setting up this company, and he has a lot of promotional capacity in his group. This was the first carbon streaming company going public, and also with a big market cap. And you can see that these promotes, it was obviously a promote. I'm not saying there was no value in the company, but it was highly promoted, and that's why it got this high market cap, high share price. And in 2021 and 2022, lots of carbon streaming companies went to the Canadian markets. And carbon streaming is just a financial arrangement where companies provide upfront capital to carbon offset projects like reforestation, for example, and in exchange for a portion of the carbon credits generated. So this became sort of a new business model around the environmental, the greening of the world. And Marin Katusa was one of the first people to get involved with it. It became popular, and these themes, sometimes nickel is the big thing, and then .com is the big thing, and then AI is the big thing. Carbon streaming was also a big thing back then. And I think that the war in Russia, Ukraine also made a bit of a change there, because suddenly energy became, a concern. Energy prices went up, and carbon streaming as a thesis went out of the window for a while. And Carbon Streaming Corp, this company, went down and just fell all the way back from 16 cents to 40 cents, 45 or something. And but the interesting thing is, and I unfortunately missed this news release, that this company got a couple of new people on board. Christian Milau, Marcel de Groot, Oliver Gareth, and you really have people from several groups connected to Ross Beatty. One of those guys was the CEO, Christian, of Equinox, and he was CEO for several years, so one was very close to Ross Beatty. Marcel de Groot is leading Pathway Capital. He is involved with a couple of Ross Beatty's companies, but also they create their own companies like Solaris. He was involved with Equinox and a number of other companies. And Olivier, he was involved with Casey Research, and that's the connection to Marin Katusa, of course. So when all these people get in at this level, the company has $50 million in cash, was trading at 25 million, so well below their cash levels. And Christian Milau, I hope I pronounced his name right, he also sells his company, his carbon streaming company, Blue Dot Carbon, for 2.5 million paid in shares of Carbon Streaming Corp. So this seems to be a bit of a positioning thing as well. But yeah, big names. Again, when we talk about network stocks, we refer to Dave Lotan's presentation at PDAC. Several networks coming together again. Marin Katusa, Pathway, and the Equinox Ross Beatty sort of group coming together in this Carbon Streaming Corp at really depressed levels, and maybe at the right time. I don't know if carbon streaming is coming back and becoming flavor of the day again. But like lithium, once the hype was over, it became interesting to look into lithium again. And maybe with carbon streaming, now that the hype is over, maybe it's interesting to step in again. Not for a big pump, but maybe for a more fundamental way of looking at it. So I missed it. The news came out at a 20 million market cap. Right now it doubled to a 52 million market cap. And I missed that move completely. I just found out about it because I saw it in the list of big movers last week.
Is that typically within the stuff that you would get involved in? Like for me, again, just I see carbon streaming. I don't know Marin personally and all these guys. I've heard stuff, but with carbon streaming, I'm just not going to get involved simply because I don't have the bandwidth to follow everything. So yeah, would you typically get involved?
Yeah, I rarely go out of mining, but when I owned a carbon streaming company at the time, which was a royalty company, a mining royalty company, and carbon streaming combined, and they separated the businesses sort of. I think it's still in one public company, but it's sort of structured that the green company can go out of that company. So I was a little bit involved in carbon streaming in 2021, 2022, and when I see these names coming in, when at a level that's 50% below their cash levels, then you know that a new sort of push is coming. And this is not just one big name. You've got like Marin Katusa still, will probably put his muscle behind it. You've got Marcel de Groot, Christian Milau, all coming together in this one company at this time, and they will have a plan. They're not just coming in and now start wondering, hey, what shall we do? So I think it was a very easy thing to buy if I would have noticed this thing in time, and I didn't for some reason. But yeah, I would have bought it, and I'm not sure if I would probably have called them up to find out if this would become a longer term thing for me or just a quick trade. But if I would have seen this in time, I would have noticed immediately that this was an opportunity, but I didn't see it. Probably because my alert systems were not triggered because it's not mining related. But
Right.
yeah.
Okay. You also have Sendero Resources here in the list. It did go up, not a whole lot last week, about 50%. It's down another 17% now. We're actually recording this on Monday again, as I said, had that surgery, so we had to do it in between. But it's I've interviewed the CEO before, and he was kind of over promoted at first. I believe I told him that during the interview too. And I need to get him back on an interview again because they're doing some stuff with the financing and whatnot. The holes didn't come back as they expected in previous times, so it had a, it was kind of a crash, so, right? So it was promoted,
Hmm.
it went up a lot. It had a high of 40 cents or something like that, like 6 months ago, less than that, and then it dropped down to a low of like 5 cents or something among those lines. So yeah, I don't know what he. I have to get him back on for an update because it's not. Yeah, I have to get him back for an update. What do you think?
Well, I think it's what I want to point out with this story is I spoke to them in March at PDAC when the stock was still at 40 cents. And they presented, and well, an interesting story listening to be honest. And that's the danger in this industry. I mean, you listen to a story like that, and you think it's interesting, but I also realized this is a story that started following the Philo discovery, following NGX, following Lundin Mining with Jose Maria. So this is sort of a closology play. And you can very quickly create expectations because everybody has seen those amazing successes with Philo and NGX and Jose Maria. Yeah. But those discoveries didn't come overnight. They came after years and years and millions of dollars of work. And when you then come in as a smaller company, but still decent 30 million market cap, and you start working on that project, and I don't frankly know a whole lot about the project other than the quick pitch that I saw in March. But I did realize, okay, this company has a 30 million market cap. That's already a level that you need to defend some value. And if all these people are watching it and potentially hope for this big philo type hole or maybe something that at least hints at a new discovery, then there's a very big risk that those expectations cannot be met, and the jackpot wasn't hit immediately, and then you get a sell off. And it's just very difficult with these stories because they have such an expectation level and often only one play, that all the eyes are on the same thing, and if that one thing is not immediately amazing, the stock sells off, and then you go from 40 cents to 7 cents. You have to do a financing at that level, a painful financing because it's $3 million financing at 8 cents with a warrant. And of course, at some point, such a company reaches a low because it becomes a $4 million market cap, and suddenly people realize, well, at this level, it's pretty cheap. You know, you've got a land position, they have the money again, the money is sort of committed. And maybe there's good money coming in. I'm not sure who is buying the financing, but a new president is announced to the company. So then suddenly things can change again, and it can go back to sort of a more decent share price, perhaps from 7 cents to 10 or 15. I don't know, but I just wanted to show that be careful with companies that very quickly get to a 30 or 40 million valuation and depend on the next drill hole. You have to realize that these things can happen and you can lose 90% of your money in such a story. And there are many of these stories. Even, I mean, one of the companies I experienced this with is Barksdale. We discussed it recently. I bought it, at 30, 40, 45 cents, and stock went to 90 cents. Very happy. Finally got all the permits, started drilling, came into some trouble with the drill contractor, and people knew there was a financing coming. Drilling was not going as expectations were high, not an immediate bonanza drill hole, and the stock landed at 15 or 14 cents. The company didn't really change that much, and I think the same can be said about Sendero. It is the company is probably still has that upside or that potential that they had a couple of months ago, but the share price and the complete expectation level can just be pulled away, and the stock then crashes, and then you have to reconsider whether or not it is still interesting. Of course, it's way less risky at $4 million than at $30 million.
Hmm.
And same for Barksdale, but you have to consider like what's this financing going to do for them? Who is coming in? How are they going to get back on their feet and slowly build their share price again? And you don't only build share price because it's fun or because you want to make money. They need to go to a higher share price to also be able to finance these big programs. Because if you drill deep holes in Chile, then you also need a bit of money. And you rather raise at 20 cents next time than at 7 cents. So you do worry about share price, not only for your own returns, but also for cost of capital. And in that case, Sendero is a bit similar to Barksdale's, at least from how it went from high expectation to suddenly being out of favor.
That is a very good point that you make there, which is also why the market cap always matters to me nowadays. It wouldn't have been that case before. Before it was really just sentiment and mostly FOMO that would drive me. But stuff like that, when it's pre-drilling or pre-drill results, and the market cap gets relatively high, I'm already like I'll pay attention, but I'll be careful. And I need to get Rick back on too, by the way, from Barksdale. I've had him on once or twice. And I need to get him back on soon to discuss some of these things. But yeah, I have to get Michael back from Sendero to see what's happening because yeah, 6 million now. The market cap, again, what did I tell you? Went to 45 and now it went down to 5 cent. Now it's up to 9.5 cents. So it'll all depend again on the financing. Are they going to JV this? Because there's potential for that. Last time I spoke to him, he told me there's potential for JV, for JVing the project. So it'll be interesting to see if there's an angle there. But yeah, this is actually a good point. Michael is right here with us in the room, so this is a good point to let him in, because we're gonna be talking about these things also later on, hopefully. And Michael, let's maybe start you off lightly before we get into the spicy stuff later on. But so you're in the news enough that I believe a lot of people will know who you are, but you do have sort of an interesting career behind you, and hopefully ahead of you too. And but so it goes all the way back to the year 2000, where you were apparently bringing coffee to the Scotia Capital guys. And then through the years, you also had various roles on the buy side, so on the issuer side of the story as well. So how does that happen? Like, how do you go from coffee in Scotia to, managing a lot of money in junior mining?
It's a lot of hard work and a lot of twists and turns along the way. I'd say I remember a funny story. My first real job was on Bay Street. Scotia summer intern. I was a university student at the time. I was placed on the derivatives and trading desk in Scotia Capital, like kind of top floor of their big tower in Toronto, like 65th or 68th floor in Toronto. My first day, I showed up. I didn't know what trading floors looked like. I'd always dreamed to work in the stock market, and I showed up wearing a three-piece suit, polished shoes. And I get there and everyone's wearing baseball jerseys and jeans with their hats backwards and throwing paper balls at each other because of the trading floor. So very relaxed but intense atmosphere. And my first day on the job, all the traders start throwing out their Starbucks orders at me, saying, "Hey kid, your job's bringing me coffee." So they threw 30 coffee orders at me in a span of 5 minutes, and I was freaking out because I'm like, I don't remember any of these orders. They're yelling at me. I don't want to screw up and piss off the traders on the first day. And thankfully, one of the partners came to me and handed me a pre-written list of all their custom orders they wanted for coffee, and she said they do that to all the new guys on the floor. So it was a little lesson on the levity of Wall Street sometimes. From there, I went to Formula Growth, which was my first full-time job, small mid-cap equities, Canada, US, running. The firm ran about between 500 million to $1.5 billion when I was there. Went from junior analyst to senior analyst to portfolio manager. When I left the firm in 2018, it was running about $1.5 billion. And my partner, I, Charles Hager, and a few others ran about half that money. It was market neutral and a concentrated strategy. But throughout that whole arc, the first sector I covered was actually commodities. And so I kind of stayed in commodities from 2000 all the way through my career. So I was a generalist fund manager with extreme specialization in commodities. So from my late teens to early 20s, I've covered commodities for the last 24, 25 years. And I covered it extensively at Formula Growth. And yeah, in 2018, to finish the story, in 2018, I had twin daughters that were born to my wife and I. Was very blessed, and I had three young kids before that. So I had five girls under 8 years old looking at me in the eyes at home. And my job was very intense, traveling around the U.S., running a lot of money. So I decided to take a little time out from my career, semi-retire at that point in time. And I was extremely bullish on gold and precious metals at the time. So that was 2018. Late 2018, I think gold was 1350. It had just risen from the lows of 2015 at 1100 when I started investing heavily in gold at Formula Growth in my old job back then. I was sitting at home, and in my old career, I used to invest in 200 million to 10 billion market caps. But I had a lot of my own money over the years that I'd accumulated through investing my own capital, and I was really bullish on gold. And I just saw the total destruction of the junior mining sector. It was coming out of a 6-year bear market where the companies were completely starved of capital. So I wrote my first check in late 2018, and I saw a huge opportunity, and not only in the stock prices and the valuations, but also to improve the management, the capital allocation, the strategy of these companies. A lot of them were run by geologists who had, good geological instincts, but very poor understanding of when to raise money and how to create shareholder value. So what turned out to just be an opportunistic investment ended up turning into a whole new career thrust. So, one check went to about 20 to 25 checks, where I'm the top shareholder of probably 20 to 25 junior mining companies across Canada and globally. And just found a new passion to direct my love of commodity investing into a space which is wildly inefficient and honestly in need of more sophisticated investors kind of getting behind these companies and trying to improve the outcomes for shareholders. So I've kind of become a proactivist, you call me. I'm not activist, I'm not a troublemaker, let's say, but I try to bring added value when I write checks to the companies to help improve the outcomes for shareholders, and myself obviously is one of the biggest investors when I do that.
I was thinking like what kind of a person goes from a market neutral fund to the junior space, and it's probably one that hates themselves or someone who's got 6 girls at home. That makes sense. Now I understand everything. But so you're a top shareholder in all these companies, as you said, and you've been doing this for now, yeah, a couple of years.
Six
Not
years, probably 5, 6 years, 2018, 2019. Yeah, so 5, 6 years now. Yeah.
are you keeping track of the performance? Like, do you have a CAGR for me?
It's been pretty good. I mean, I'm pretty private about my financial disclosures, but I would say I've soundly up front, probably even despite being in a bear market, 5x my money since I got involved, maybe 6 times my money in the sector. The sector really hasn't done anything since 2018, as you guys are well aware. The GDX is probably flat since that point in time. Obviously, with a lot of volatility, I put the caveat around that. A lot of people don't understand, I think, how to make money in the junior mining sector. They might say, "Oh, I hear Luke or Antonio or myself talking about a stock on a podcast. Let me go put all my money in one stock." I think that's the wrong methodology to use in this sector, but a lot of people do that. Really, the right approach for me is a venture capital kind of private equity type approach where you make 20 to 30 investments, full well knowing that a vast majority of them are going to be busts. But the ones that work out make you 20, 30, 50 times your money. Those are the ones that drive those kind of 5, 10x returns for the portfolio as a whole, right? So you gotta spread your bets. I am an aggressive investor. I like to be concentrated, but in a junior mining portfolio, even 20 to 30 investments is relatively concentrated. But you have to understand that the range of outcomes is going to be very wide, and failure is the norm, not the exception, right? So you've got to really try to pick as many winners as you can, but understand that many of them are not going to work, but the winners will pay for the rent, so to speak.
Are you only getting involved when there's an issue to be solved? Like you just said, a financing issue. Maybe the company is not good at financing other corporate matters. Or are you involved as well when you think the company is doing quite well, but you just want to be involved because of that reason?
Yeah, I mean, look, it's a great question. I mean, so what I tried to do when I got in the junior mining space was kind of reverse engineer. I'd been investing in producing assets for 20 plus years when I got in the junior exploration space. Quite often single asset producers, so I'm investing in small mid caps, right? So companies that have crossed the bridge from discovery all the way to production. And so not having invested in microcap stocks kind of professionally for most of my career, but investing heavily in the sector, I kind of went through a checklist in my mind. Okay, what are the attributes of the producing assets that I've owned over the last 20 years? What are the attributes that they have? Because when you're investing in a junior mining stock, unless you're just speculating or trying to trade drill results or assays, that's not my game. Because the checks I'm writing, the size I'm taking, I'm really looking for a liquidity event, which would be a takeout or some kind of moment where the stock really achieves that recognition from the market that this is a mine. So, what are the attributes of actual mines? And how can you identify them really early on in junior exploration companies? So, my whole quest when I invest in a company, Luke, is really to identify potential future mines. And I'll go through that list. And as you guys know very well, there's 100 reasons to say no to investments. So when I look, if I have 20 stocks in my portfolio, probably looked at 500 to 1,000 junior mining companies in the last 6 years. Sometimes say them once or twice over their life cycle. So you say no 99% of the time. How do you find those 20 to 25 names that you believe, even though full well knowing you're going to be wrong on a bunch of them, that have a chance to be a mine? And that's what I go through. So even if you have a $5 million market cap, even if you've only drilled one hole, haven't even drilled a hole yet, there's plenty of reasons to say that stock, even if they have success, will never be a mine, to try to say no right away. the ones that come out looking good, those are the ones that I want to spend more time on. And then it's a function of, what's the valuation, what has to be fixed, what has to go right for that company to be a successful investment. And there's many reasons why that might be no. So yeah, I mean, I've said publicly before, you can change management, but you can't change geology. Or you can't change the geology and the location of the project, but you can change management, you can change their strategy. So I'm less worried when I see an amazing geological opportunity with a real good potential to be a mine, where there's management tweaks to be made to a certain extent, right? You can only do so many of those without getting exhausted because they do take a lot of time. But for me, it's the asset first, potential to be a mine. What's the valuation? What's the opportunity if I'm right? That's really what I focus on in terms of my initial screen.
I had a Luke. I'm sorry for jumping in here because I see that you want to continue, and I want to talk, Michael, about your criteria as to how you pick those stocks later on. But something you said here made me just want to go back to your career for a second here, because you said the checks that you're writing, they need liquidity, which makes me think that you were rich before you got into this. So how'd you get rich? How do I get rich?
Yeah, investing. I mean, I didn't. I came from a very humble background. My first job was sharpening hockey skates for $6 an hour. I was a passionate investor in the stock market at 16, 17, 18 years old, and so I would take my cash that I earned sharpening hockey skates and deposit it in my stock brokerage account and started buying stocks by the time I was finished high school. I got hooked really early on. I think the first ever investment I made was during the tech boom. I found a company that had a GPS tracker for stolen cars. So this is before we had GPS embedded in cell phones in the car. So if you had your car stolen, they could tell you where your car was. It was one of the few tech companies in the 90s was actually making money. I refused to invest in dot-coms. I've always been a bit of a fundamental value type person, so I didn't want to get caught up in that dot-com frenzy, but they were making money. My first investment, I think, went from like 10 cents a share to like 50 cents a share. Like I made like 50 times my money on like $2,000. So that'll get you hooked pretty quick in terms of potential of the stock market. It was a lot more attractive than making $6 an hour sharpening hockey skates. So that got me really interested in learning more about the market, investing my own capital. Subsequent to that, I invested oil and gas in the late 90s. I've always been a bit of a contrarian myself as well. I think it's really a really useful trait to have in the commodity sector. You buy when there's blood in the streets, you buy when people are very negative, because when the sector turns, you can do very well. So in the late 90s, I was investing in oil. I mean, oil back then, they were talking about it was $10 a barrel. And there's a big headline in the newspaper saying oil's done. It's going to $5 a barrel. Well, instead of going to $5 a barrel, it went to $150 a barrel. And so I was making oil investments back then. Had a couple of companies that went up 20, 30 times my money in oil investing. So that really got me hooked, one in the market, two in commodities, because I saw the potential when you combine a cycle, a turning cycle with discovery or major value add on the exploration front or development front, that you can have these massive home runs in the commodity space. So that was my early pool of capital, and obviously investing in the markets over time, having been successful in my job at my professionally as well, provided a lot of opportunities to grow my worth. And the nice thing, Antonio, was investing in bear markets, for, I mean, it's still a material amount of money, but for $200,000 check at the low of the market, with a $5 million market cap, you can get 5-10% of the company for a relatively small amount of money. And when the cycle turns to 10, 20, 30 times your money, it starts that up pretty quick. So I think the combination of starting early, finding stocks that can go up 30, 40, 50 times, having smart timing around cycles, that's how you build wealth. There's lots of ways to lose money. We can talk about that too, but over time, if you do the right things and have discipline, you can do very well.
The only thing I heard was stolen cars, so I'll write that down for now.
So yeah, I think that opportunity in oil came again in 2020, right? In 2020,
Yeah.
Oil was negative, and you could have bought almost any stock, and you would have made 10 times your money or more. Is that something
Correct.
you did in 2020, or you were only focused on the mining stocks?
Luke, it was a bit of a bandwidth issue. I'm being fully transparent. It's probably my greatest regrets. I was heavily involved in the mining stocks in 2020. I'm on board, strategic advisor, had all my portfolio basically lined up in mining stocks. And then oil went to zero. And full disclosure, I can send you the email. I dropped everything. I said, okay, that's it. I'm not doing mining for the next 2 months. I'm refreshing all my old relationships on the street. Because a few things, Luke, I saw oil go to zero. That's one thing. But what I also saw was all the companies were merging together. They were cutting their CapEx budgets. So they used to spend 150, 200% of cash flow. It used to be grow, grow, grow was the oil and gas mantra back then. So they were growing production very quickly. The market was rewarding producers for growing. And that all changed when COVID hit and oil went to zero. The companies started merging. So they're going to pay our cash flow as dividends. We're not going to grow anymore. And so I could see supply flattening out and rolling over. At the same time, I believe that demand was going to rebound on the back of COVID. So I dropped everything, called all my owners from the street. I had made a shopping list of like 20 oil names that I wanted to buy. I was ready to rotate some of my portfolio out of the mining stocks into oil and gas. And during that work, the Pfizer vaccine came out like a month into my due diligence process. And oil stocks all ripped 30, 40%. And despite being a very experienced investor, I made the classic mistake that even most inexperienced investors make, which is, oh, all the stocks I want to buy are up 30 to 40%. This COVID vaccine rally is just it's a red herring and stocks are going to pull back. And when they pull back 20%, I'm going to buy them all. And as you probably saw, they didn't pull back. They just kept going and going and going. And at a certain point, I felt I had missed the boat, which again wasn't true because they kept going farther than I thought. But yeah, that's exactly when I see that kind of situation, Luke, that for me, I love blood in the streets of the commodity, especially in a commodity where I believe the outlook is positive, right? So I believe the oil and gas demand was going to come back. I believe in the EV vehicle revolution, but I think it's going to take slower and longer to come about. So I felt oil demand would be longer for people to think. And the commodities were trading at fire sell price and the stocks were trading like bankruptcy. So that is the ideal setup. Unfortunately for me, I missed that window because I was so heavily invested. And my approach to being more of a private equity investor, I don't trade my stocks. So I'm very sticky long-term holder. So I wasn't a fund manager back then. So I didn't have extra funds to still like get inflows or allocate capital to. I'd have to sell something to buy. So a few factors made me miss that ride. But yeah, that is the classic setup. It's actually what got me in gold, Luke, in 2015. Gold was 1100. It was the same setup, right? Gold's 1100. It's a relic. It's going to crack 1,000. Nobody wants it anymore. I jumped on the first plane to the biggest conference of the year, the Bank of Montreal Mining Conference. I did like 60 meetings. I had looked at gold for several years before that, but I'm like, this is blood in the streets. This is the kind of Freeport was going bankrupt. Barrick was going bankrupt. Like all the majors were upside down. Like to me, that is the ultimate opportunity for commodity investor because I was very bullish on gold long term. If you're negative for a reason, but if you're positive and the market's negative in a commodity sector, that is incredible opportunity to make money if you're right.
And especially, I think when you're not yourself invested, I only experienced personally this once. I was in oil in mining for about 10 years when in 2020 stocks all started tanking, but for some reason I saw the risk and I sold almost everything in the month before everything started to go down. And when you're not in the market, but you do realize that that blood in the streets is often, I mean, you have to evaluate it. But in my opinion, it was a very short-term thing. So I went back with full strength into the market again. So I think it becomes easier when you have cash available and you realize the market. And I think that happened to you probably in 2015 a little bit, where you could see the opportunity, but you didn't feel the pain as much maybe as the people who are fully committed to the sector already. Did that make a big difference?
I mean, it's a huge point, Luke. I mean, as you know, much of this business is holding your emotions in check, right? I mean, I was very fortunate. I taught at the university, one class moonlighting for 10 years in the university I taught at, the students got a chance to meet Warren Buffett in person. So I had a very amazing opportunity to meet him with my students. A 3-hour dinner at his famous steakhouse that he eats at, and he answered questions for 3 hours. Brilliant. He's in his 80s and he answered 3 hours of questions, sharp as a tack the whole time. But one thing he said, if you're looking for, so what's the key attribute to be a great investor? And he said, I'd rather take a student with 130 IQ and very high EI, emotional intelligence, able to keep calm, understand the situation, not lose his or her cool, than someone with 170, 160 IQ, a genius who can't keep or she can't keep her emotions in check. Because 90% of this business is staying calm and rational and doing the right thing when everyone else is screaming at you the opposite. So maybe it's not buying NVIDIA today is the right thing to do. I'm not a tech expert, but everyone's yelling at you to do it. If you're missing out if you're not doing it versus buying gold stocks in 2015 or oil stocks in 2020. If you've lost 50% of your money, it's so much harder emotionally to go, I've lost 50%. How do I have the courage to put more money behind this trade when I know it's the right thing to do, right? It's very, very hard. So that's what Buffett was saying. Having your emotions in check is one of the key successful factors to be a good investor over time.
Well, what about a ginger with 85 IQ and no soul?
Probably not the right place for him or her.
Well, he just made an amazing return in Awali, who made a big discovery. So well done, Antonio.
Yeah, Michael, when are you buying Awali? That's actually the main question that we wanted to ask you.
We'll take that one offline. I have nothing against it, by the way. I haven't dug into it too much yet.
Yeah, you should. Okay, but no, we actually did want to talk about that process of yours. Like, what's the criteria? Because you take big positions, right? That's actually the first point, maybe before we talk about the criteria, is that you have these multiple insider positions technically, right? Where you have 10% or more of the companies, and you've been you're currently a director of some of the issuers as well. You've been a strategic advisor, but then you also manage Bastion, which is a fund, right? So you're on the buy side. So how do you balance those two worlds of being on the buy side with clients' money or whatever, and then on the sell side, sort of personally with the issuers?
Great question. So when I gave my career arc early on in the interview, I said I had 5 girls under 8. I left the institutional money management business just to be able to spend more time with my family and have control of my schedule. I thought I'd be miserable when I left my job in 2018 because I've only wanted to do that since I was a teenager. It was my dream job. I love what I did. I love the people that I work with. When I left and I found junior mining, I realized I was having even more fun doing that, even more success, and leaning even more into my strengths, communication, investing, strategic thought. So 2 or 3 years into that mining arc, I'm like, you know what? I'm never going back to the institutional money management business because I love what I do so much. And lo and behold, two of my best friends in the world from my former shop, who I love working with, who are supremely talented individuals, called me and say, hey, we're leaving the old shop. We're starting our own firm. Do you want to join? And literally the only two people in the world that could have called me to get me to go back in that business was them because they're so talented. We had so much fun working together. So, here I am with a big junior mining portfolio, a big junior mining allocation of my time and my energy. And then I'm back in the institutional money management. So we're very careful about that. We have a lot of respect for our clients. So luckily for me, what I was doing was, sub 30 million Canadian market cap, Wild West of junior exploration. And Bastion was an institutional money management firm. So Bastion's focus is $200 million and above market caps, back to the old single asset producers, cash flowing miners and producers and other sectors, healthcare, tech, retail, et cetera. So the lines are very clearly drawn. So what we did is that anything below $100 million market cap, I can freely allocate capital to because Bastion would not be touching it. It's just too small and too risky. Anything above $200 million market cap, our Bastion clients have first priority. So because I'm fishing in really tiny companies, it's my dream that some of those companies I invest in today become Bastion eligible investments. It means that I've made a lot of money in that investment, but they're just two different worlds, right? So we've kind of drawn the red line there. What it does do is it gives my partners at Bastion, I cover the whole arc from Junior Explorer Co. all the way to Barrick. So it gives us an incredible perspective on the whole market, right? So Junior Explorer Co's are not going to work when Barrick and Newmont are making 52-week lows. A lot of junior exploration investors don't understand that the importance of the larger caps and mid caps have to work and be good stocks first before the juniors can work. So having that wider perspective, it makes me a great investor. And it also creates a farm team investment. Since I'm following these companies from very early days, the ones that do graduate to be Bastion eligible, I'll have, at that point, 5, 7, 10 years history with these companies. I'll know who the good actors and bad actors are and who the good investments are and who the good projects are. So I think it gives a good perspective to our clients across the whole portfolio. And also, I'm not the lead portfolio manager. My partner, Charles Hager, is the lead manager of the fund. He's there 5 days a week. He's doing all the portfolio allocation. My job at Bastion is covering the commodity sector and being a significant support to Charles as a senior portfolio manager in terms of supporting him in decision making. Worked together for a very long time. So it worked out very well, the best of both worlds. Get back to my first love, which is institutional money management, and staying in a sector that I really love, which is junior mining as well.
So your role on these boards is not like you're not there for the salary. I don't know if there's a cash component to your salary every time or not, but you're there to help the company move forward instead of, it's not a career. You're not a board. You're not a board career. Career board, whatever.
You're not going to support a family on board fees from junior mining exploration companies. Let me tell you, you're definitely not in it for the cash salaries there. Most of them pay nothing or very little. I'm there, Antonio, because I own 10, 15, 20% of the company. And I felt the project had sufficient merit that it needed a firmer hand on the steering wheel and more of my time. So I'm really in it for the equity. I call that my sweat equity component. I do spend many hours a week on those boards and timing, but a project like Northern Superior, which I've been involved in since 5-6 cents a share, we've taken that company from exploration company to a company that's 4 million ounces and one of the best camps in Quebec, and now has $100 million market cap and is now trading at 65-70 cents a share. The entire time, I think it wouldn't cover very much of my living budget for a month or two of the salary I've taken in 6 years from that company. It's the cash flow de minimis from the director fee, but the equity appreciation is where I made all my money. So on the projects that I think have real potential to be 20, 30, 40, 50 baggers, that's when I'll become a board member and advisor because I see the value of my equity increasing and I see my contribution to that company increasing the likelihood of it being successful.
Would you even, when you get into a story and you get to meet that management team for the first time, or maybe you already knew them, would you even demand being in charge or at least being involved in the raising money part, because I think raising capital and cost of capital are probably the most key things a junior mining company has to think about. And often that's the most, well, not every company appreciates those two things. Is that something that you want to be involved in when you get into a company, or are they still free to do whatever they want in terms of financing once you get in?
I mean, absolutely. That's the first thing I identified when I made my first check in the junior mining sector. What I saw was a bunch of mistakes they make. We could do a whole interview just on this alone, but I would say the first mistake is they raise money when they desperately need it. So they wait till their treasury's down to like zero or almost negative working capital. And then they go on a roadshow saying, would you please invest in our company? Well, if you're going to do that, you're on your knees basically begging for money when the investors on the other side of the table know you're bankrupt or have no more money. So obviously the terms are going to be extremely favorable for the counterparty in that. So I've taken advantage of that myself when I found good opportunities where it's got a great asset, but the company has no cash. Well, then you're probably dictating terms. So I try to avoid my companies getting back into that situation when I'm a 10, 20% shareholder. Second thing they do is they raise money from the wrong type of investors, right? So this industry, I mean, for your international viewers, but flow through shares are very common in Canada where they get a tax advantage by investing in these companies. A lot of these investors could not care less what ticker they're buying as long as they get the tax break. And 4 months after the deal's off trading hold, all those shares are for sale in the market. So you raise 5 million to flow through on January 1st, and then on May 30th, you're dealing with $5 million just for sale in the market because all those shares come off restriction, and none of those investors care about the ticker that they own. So that you're raising money twice. So the money's easy to get, but very, very painful for the corporation that raises it. So I've tried to steer my investors away from that and actually trying to find, real back-end investors, I think like me, that want to make 10, 20 times their money, will be there to hold the stock even if it goes up higher and also invest in future financings. So that's another one. The third one, as you guys know, is warrants. I love warrants. I love getting warrants when I invest in companies. But if you put warrants in the wrong hands of the wrong investors, they sell the share, flip the warrant. So you do a $5 million financing and there's $5 million of shares for sale 4 months later. And those guys hang on to the warrants as a free ride, right? So structuring financings, who to raise money from, when to raise money, how to raise money. That's the contribution I felt I could bring early on when I was joining these boards because that's my area of expertise. I'm not going to get in the geologist's face and tell him, can you alter the azimuth of that drill hole, please? Or can you move it over 5 meters? I trust the explorationists to do that. But I will get involved in saying, hey, some of these holes that you're drilling are nice to know. They're scientifically curiosity holes, but I'm focused on commercial discovery. So I'm constantly asking the hard questions of, is this hole going to get us closer to commercial discovery? Yes or no? Do we have a commercial discovery? Yes or no? If we don't, let's stop drilling there because we're just drilling for the sake of drilling. So in terms of capital allocation, I like to get involved in that as well. But obviously about trusting the science and the targeting to the geologist, but having more fulsome discussions about return on investment. When you're putting dollars in the ground, the goal has to be to increase value. I'm not saying geologists don't want to do that, but quite often they get seduced by the thrill of the chase or learning more about a project. But in an environment with limited dollars, you've really got to maximize your investments into areas that can really become a mine or a commercial discovery, because that's how you're going to be wealthy and create wealth in this business.
Those flow-through companies you just referred to are probably very interesting to you because in a way those flow-through financings lead to share prices being completely sold off, but the flow-through money is being used in the ground. So what I often see is that those companies actually come up with some results, a $3 million valuation. Yeah. And if you can then convince the management team, like, hey, you probably need some support and you are only a $3 million company, let's change that together. It gives you a good entry point and it gives the company a better future going forward. So I actually think that those companies may even be quite interesting sometimes for your entry purposes.
Correct. Absolutely. I mean, one thing I look at, Luke, I spend a good third of my time looking at the cap structure, who owns the shares, what's going to be for sale, what's not going to be for sale. If you walk into a situation where 60, 70% of the float is owned by strategic investors that are long-term, and or you walk into a float where half the float's owned by flow-through shares, well, that's going to affect your timing of your investment. So again, we talked earlier about, here's what I want to find potential mines, but the timing of when I make my initial investment will vary depending on what I learn of the share structure, when they need money, what's for sale, what's for not. But you're right, you need to be aware of these things when you're making an investment, because the best project, if you get overwhelmed with 30 million shares for supply for sold for no other reason other than tax benefit, that can have a negative impact on the stock when the project itself has had no impairment at all. In fact, the project might be more valuable after the drilling if the stock is going down, right? So those are great opportunities. That's why I love this sector, because there's so many inefficiencies in this market. So if you be able to do the work, that you can really add a lot of value by spending time analyzing these companies.
Antonio?
Yeah, that this is where I think we can. Is there a list? Like, do you keep do you have a checklist like when you open it up and then you start going through? So I was trying to note down some of these things, and because you mentioned market cap, and share structure and so on and so forth. Do you have a list of criteria that you can share with us?
Yeah, I mean, it's there's like different levels. I have like 5 or 6, 7 high level things that I look for initially, but then as we just talked into finance there, right? I might talk about I'll give you the cap structure and finance, and I'll go 7 or 8 levels deep in terms of beyond that, right? But from a high level, like I said, because I'm thinking about a venture capital type model, first thing I look at is if I'm right, can this stock make me 20 to 50 times my money, right? So if I find an amazing opportunity, but it has a $200 million market cap, and my threshold is now $4 billion market cap, right, to make 20 times that money. So it's not that I don't like larger caps, but they have to be very exceptional projects on my initial check at $200 million to say it's going to go up 20 times. So I'm looking for 20 to 50 times my money. That's the first thing I'm looking for on my initial check. I can increase my checks over time as I get more confidence because if you've made 10 times your money, but you think the next 10 times is a lot easier because your project is de-risked and on the right path, right? Second thing I look for, which will dictate all my future analysis, will be does this have potential to be a mine, right? Can this be an economic project? And then that filters through so many different things, right? So you're looking at what's the scale of the project, right? Does it have enough tonnage or ounces of whatever commodity you're looking for to meet the economic thresholds of a mine? Grade, obvious, but grade is margin. So does it have a high enough grade? You might have a big scale project that doesn't make enough margin. It's not going to have the cash flow to cover the capital costs, right? Infrastructure. So when I look at a project, if I'm in an area that has 7 mills and road access and power running through it and existing operations to take maybe tailings operations from existing producers, that dramatically lowers your cost, right? In terms of the capital required. It also lowers the size and grade that you need to be an economic mine. Another one I would look at would be jurisdiction. I'm not afraid to go anywhere in the world with my investments. I think there's advantages and disadvantages to being in, let's say North America versus Africa. We can talk about that. But is it an area that has a social license? Does it have the access to the reserves or resources that are in place? Does it have the ability to operate with the locals, whether it be First Nations, Indigenous populations, or even local populations? So you can have an amazing mind, all the attributes, but if your social license is blocked, you're never going to become a mine. So jurisdiction is a bigger discussion. It's not Canada good, Africa bad, or Africa good, Uganda bad. It's more of a localized sensation that you might get from those things. Then I'd go into finance. Do they have, like Luke said, do they have the understanding of how to structure financings, when to raise money? Do they have someone on their board or management team that understands capital markets? Can they tell the story effectively? Do they know when to raise money? Do they understand why flow through shares can be difficult sometimes or warrant clippers should be avoided? So they have that expertise on the board. Do they have the geological expertise on the board? I like to call them a commercial geologist. So you can have a fantastic geologist, but do they have a geologist on the board or on the team that really is focused on economic discovery, like really being very harsh about does this project deserve the next drill hole or not? Are we on the right path or not? Be that. And then I would say, who owns the stock? Board, management, insiders. I really like to be in stories where the board and management own a lot of stock and not stock they all got for a penny a share on a promote, but stock that they put real money into. Because I think when you have your own money heavily invested in something, I'm on a lot of boards. I spend a lot of time on those boards. And it's not for the $10,000 a year stipend I get as my board fee. It's because I own 10, 20% of the company. So I'm up all night working on the financing, up all night working on M&A, because I know if I create value, my shares are going to go up in value. In a junior mining company, you might have 3 or 4 full-time employees and 6 board members, right? If your board members are fully engaged, you've more than doubled or tripled the horsepower that team has. If your board members only show up once every 4 months for a board meeting for 2 hours and then go back to their day job, you're going to get less horsepower out of that organization. So that's another thing I look at, really closely. And then finally, I'd overlay where are we in the commodity cycle? We talked about that earlier, but if we're at a negative sentiment period in the markets, like we still are in precious metals, which is so shocking to me, where the sentiment is negative, but the fundamental outlook is good, then that's the wind at my back. If I get all those checklist things right, and then the commodity starts to blow my back or the sector starts to turn, that's how I turbocharge my returns. So a few years ago, lithium was on fire. I was not taking any lithium meetings at all, just because my sense was lithium was going to be going down, not up in the next 2 years. And that environment is very hard to make money. Where I'm not bullish on lithium right now, but I'm starting to take lithium meetings again now because sentiment is kind of swung negative. So if I'm going to spend time, I want to be in a more depressed sentiment with a positive outlook. And that's sort of overlaying my timing of how I spend my time, whether it be oil and gas or gold or lithium. That sort of dictates my allocation of my energy.
I mean, you explained your criteria, but how do you find them? You talked about conferences or meetings already. Is it often you making the first introduction because you got interested in a story, or is it often the company reaching out to you to get a meeting and try to pitch it to you? Is it always one direction, or is it both ways?
Both ways. At the beginning, Luke, when I was just getting my feet wet in the sector, I was me making most of the calls. And now, as you know, if you're a junior mining investor and you say you invest in juniors, your LinkedIn inbox or your phone messages or emails, they find you. I mean, they're coming from everywhere. My first mentor in the business and my first job, John Dobson, was an incredible man. He was very, very successful. And he always told me, surround yourself with people that are way smarter than you, right? So know what you don't know. And when you don't know something, make sure you're surrounded by people that are brilliant or way better than you. He's not afraid to be surrounded by people that are really smart. Some people are. Some people have too much ego to be around people that are smarter than them. So when I got in the mining business, I realized I'm not a geologist. I've never built a mine in my life. I know what I don't know, right? I mean, spending 20 years looking at this stuff, you might think you know how to look at a cross section or geology or a geophysical anomaly, but the reality is you don't know as well as someone else. So I've created a network of experts, be geologists, mine builders, engineers, local experts in different geographies of the world that are heavy on mining. When I find something that in my first pass, ticks all the boxes, my next step is the next level will be go to those experts and tell me, what am I missing? What am I missing socially? What am I missing geologically? What am I missing from mine building perspective? And quite often, those people are negative on projects and they'll get crossed off my list because I've missed something, right? So it's a kind of iterative process. The other question you asked, Luke, too, would be I go to a lot of conferences. I go to all the big mining shows. I talk to a lot of the brokers, analysts on the street, friends that I have that invest in the sector. So I have no shortage of idea flow. But my favorite introduction is coming from someone that I really know is really smart, who thinks like I do and says, hey, Mike, take a look at this idea. I've done a bunch of work on it. I know the people, they're good. Those go to the top of my list. But I'm still happy. I went to Quebec City last week. I did, 25 meetings in 36 hours. Like I'm happy to meet a brand new story. But if I have a referral from my network of people that I trust, that goes much higher up on my list. But in this game, Luke, it's turning over rocks. Look at as many companies as you can. You can't look at 50 junior mining companies and say the 25 I picked are the best ones. You got to look at 500 or 1,000 to really know what the best opportunities are in the market, both on a contextual basis and on a quality basis. So it's hard work, but I love it. It's the thrill of the search, right? Looking for new names. But once you find one, you got to vet it properly.
So we basically talked about where you find them, how you judge them, and kind of how you buy them too, because that's what you mentioned. You like to get your feet wet first and then buy more later on if you like it. What about selling them, or like how long is too long to hold something that's not working? Because looking at some of the names that you're holding here, I don't think I have all of them, but I have a couple of them. Not all of them are working right now. So
Correct.
how long
Yeah.
are you going to keep holding some of these companies that are not working, and how do you decide when to let them go?
So like I said, I have that private equity mentality. Part of the proposition I bring to companies I invest in, I'm not buying you today and selling in 4 months. So I have my checklist, I had my thesis. I learned early on in my career, you say not working, stock price movement is not 100% correlated to a company having the success that it's played out. So every company I invest in, I have a checklist. What are they going to do the next 6 months, 12 months, 24 months? What's the plan, right? What's the plan for value creation? When would I sell? Is when a project, deviates from that value creation. So I have a thesis about a project, it ticks all the boxes, but it's, 0 drill holes in or 1 drill hole in, and the project looks fantastic. And if they made a discovery, it would be a commercial mine, but lo and behold, they drill 3, 4 holes and there's nothing there, right? So that's an obvious, failure. Maybe you're in a situation where the social environment changes dramatically. You're in a good jurisdiction you felt was a good jurisdiction. All of a sudden, the social license is no longer there. Then it's a question of, do I wait for that social license to come back? Is it fixable, or is it permanently stalled? In that case, you can have a mine, but if you can't mine it, it's not worth a lot. So that's more of a judgment call. Management changes, changes in direction, company does. But usually when I'm involved, they don't do that because I'm quite close to the steering wheel. There's lots of reasons to sell. But if the company's progressing well and it's mainly a bear market or lack of short-term funding or just progressing slower because the market's not available to do it quicker, I'm typically very patient with those. My ideal exit is a liquidity event. So it's a takeout like a private equity fund. It recognizes I'm in an M&A cycle. I think a lot of my companies are going to get taken out once the market starts to turn to more M&A and the market starts to get stronger. Or you make a breathtaking discovery the market fully recognizes as a mine, and now the company's got a $500 million market cap trading $20 million a day. And in that case, it's basically a liquidity event for shareholders where you could sell and the company will not be impacted. But my approach is a kind of that 3 to 10 year horizon, looking for 20 to 50 times my money. So therefore, I'm not looking to trade around press releases or quarters or assay results. It's really a long-term value creation approach that I apply.
Well, that's a good point, that last one, because or the one before that, because I was going to ask you about market caps, because you mentioned that if it's 200 million or whatever, it would have to take something extraordinary for you to get involved. But like something like Snowline. Snowline is an extraordinary discovery by almost any measure. Would you still be holding this if you had bought it at, $100 million valuation?
I don't know the story intimately well. Obviously, I know of Snowline, so I can't make a qualitative assessment on whether Snowline's got another billion or 2 billion in market cap ahead of it. But I would say if I got in at $20 million on Snowline and I wasn't on the board and a director and advisor, and I felt that the market cap could go from 500 million to a billion, at that point in time, a double my money, while very attractive for institutional investors, and I understand I am one, like, for Bastion, it would be an attractive 100% return investment. For my profile, I'd probably be looking for 20, 50 times my money in the next one, right? So the 10 million to 500 million or 20 million to 500 million, that's what I'm looking for. After that, it's a judgment call, but there would be liquidity. It would be a success story in my portfolio. I'm investing my own capital. I don't have fund flow. I don't have investors investing in my fund. I don't have new inflows coming in. So the occasional takeouts that I get or big liquidity events I get, I typically like to recycle that capital back into new names in the portfolio. But that's how I operate. If I had flows coming into my fund, I could operate differently, but it's a fund of one. It's myself. So.
Okay. I think that makes
Yeah.
sense for me. But Luke?
Yeah, I think, my last question would be for, last week you came into a new story. I think it's called Cascadia.
Yeah.
Maybe you can tell us a little bit about the reasons why you invested in that company and how you found it.
Yeah, thanks. So it's actually a great end to our process because it was a really good example of what I like to do. So Cascadia was a spin out from a company that's acquired by Hecla Mining. A really strong team. The management team has been in Yukon for 20 plus years. Their core asset got taken out, but before they got taken out, they'd assembled a really highly attractive project in the Yukon, another one in BC that they wanted to continue on with. And the acquiring company Hecla was okay because they were acquiring more production, more more development stage production type asset that they wanted to build. So they spun this out. They brought it to me a year ago on the spin out, and I took a 5% position in the company back then for a relatively small check. It was a very small cap, $10 million market cap. It's still a very small cap today. And what attracted me to it, Luke, was obviously geologically in the Yukon, it's a cash property, had never been drilled before, which is, this is very, very rare. It's not a recycled project. It's back for the 10th, 20th time with new management and a higher commodity price. It never been drilled before, never been staked before. It was in the Stikine Train of the Yukon, which if you extrapolate down to BC is one of the most prospective geological trends in Canada. But for whatever reason, it had never been staked before, never been drilled. It had a huge 5 kilometer soil anomaly, very high grade copper at surface, which I really like. So it had to scale 10 kilometers away from a road. So it had the roads in place, airport close by, infrastructure looked really, really good with a team that knew their way around the Yukon. So to me, for a $10 million market cap with a great team, really exciting discovery potential. And more importantly, we talked about earlier, they said with 2 or 3 holes for a couple of $1 million, we would know at least initially whether there was, fire or just nothing there, right? So we did that investment. I did that investment a year ago. They put their first 2 holes in. It came out late last year, 120 meters of 0.3 gold, 0.3 copper, so about 0.5, 0.6% copper. First hole, second hole, both hit. Second hole was that 120-meter run. As you know, making a new porphyry discovery in your second hole and never before drilled territory is a fantastic result. Because the market was depressed at the time, the stock barely reacted. So you have 2 holes in, it's huge terrain. They came back to me this year and said, Mike, we're going to raise a bit of money. I passed on that raise just for timing purposes. But so we're going to drill 2 more holes. We did some more geophysics, and we realized that the heart of the anomaly, or the really stronger anomaly, was about 200 meters, 300 meters away from the holes that they hit. We're going to put 2 more holes in, see what we get. Last week, they came out with a press release saying the new holes hit 140 meters of much more intense alteration and mineralization. No assays, which is always a bit nervous, and they're not guys like to put out visuals ever. But because it was so material and they're about to raise more money, they had to put them out in the market. They also said that the potassic mineralization, which means you're getting closer to the center of the porphyry, was much more present in these holes than the first holes. The first hole had little sniffs of potassic alteration that kicked high grade. This one had more larger intervals of potassic alteration, indicating they're getting closer and closer, potentially to the core of the porphyry system at a relatively shallow depth. These are 300-meter deep holes. They're not very deep holes, which is also, very exciting. So to me, that went from 5% early on investment, something that thought had potential if they made a discovery to be mine, to all hands on deck. They immediately offered the company a significant amount of money. I went to 9.99%. I helped them find money from my highest quality network investors that are super sticky long-term guys. We raised $3 million over the weekend because they wanted to keep drilling. The drill's already there. They'd spent their money for the planned budget, and now they're drilling the third hole. We'll be drilling more aggressively in July and August. So again, this is still a $20 million market cap, early days, but sniffs of a potential major new porphyry discovery in the Yukon in a very prolific belt. These porphyry discoveries can get very big, very fast with a good team. Hecla owns 17%, Barrick owns 7%, I own 10%. The shareholder registry is very tight, very high quality. The new guys I brought in are excellent shareholders. So you've got a really good shareholder base here, and you got lots of future drilling that you're planning to do over the next kind of 3 to 4 months. And the kicker on top of that, you get a freebie. We have another project in BC called the Pill Project, another classic major porphyry system in the heart of that trend to Tutugon district, which has Skeena, Freeport, Thesis Gold, a lot. They're smack in the middle of that really robust belt. They're also raised $1 million to do that. So you get two big shots on goal. One's already looking to be a winner. Second one could be another second winner. Small market cap, has that 20 to 40 times the money potential with a really good team backing it. And I think the money's been the thing they've been missing, and now they got that to drill some more aggressive holes here.
I'll have to get Graham back on. I've interviewed Graham from Cascadia before. I think I met him at PDAC, and then I interviewed him for a longer interview. So I'll have to get him back on anytime soon. And Michael, I appreciate you giving us this example, because I wanted to ask you to give us an example, specifically because I look at some of these investments and I don't always get why you're going into them based on what you just told us. Because of, for example, the capital structure thing, like some of these things that you're in, like North Isle, American Pacific, Group 11, Solstice, they have more than 200 million shares outstanding. Roscan has almost 400 million shares outstanding. You're making a compromise on the shares on the share structure type of thing here. Why and how do you decide when to make a compromise like this?
So to me, I mean, shares are just market cap divided by number of slices of the pie, right? So if you look at a Roscan or Group 11, I would say 10 phone calls, you have 60, 70% of the shares tied up, right? So to me, the share structure, the number of shares is less important than who owns the shares, and the market cap is the most important thing. So Roscan's a $20 million market cap, asset that could be a producer very, very near term because West Africa can get things done very quickly. So does Roscan have 10x potential? Absolutely. Yes, they have 40 million shares standing, but do I know where 70% of those shares are with a few phone calls? I do. So it's a very tight share structure. Group 11, Glencore owns 20%. I own 20%. High net worth individuals that I'm close to probably own another 20%. So that one is again, 60% of the shares, 7 phone calls, right? So I'd rather be in a 200 million share structure where I know 160 million of the shares, I know exactly where they are and they're not sellers, than be in a 10 million share structure where 9 million of the shares are given to the founders at a penny and they're all for sale and the stock's trading at 20 cents, right? So to me, it's a percentage of the float. It's a market cap versus return and how tight the structure is. And also, again, Group 11, Roscan, the ones you mentioned, I have strong belief that those assets all have potential to become mines. That's really what I'm looking for. And their market caps are still, very, very low. So that's the game I'm trying to play. Low market cap, become a mine, keep the share structure where I know where the shares are so that somebody can trade properly, finance it properly. And hopefully, fingers crossed for all of us, we finally get that cycle we've been dreaming of in the gold special metal space to give us that turbocharge, take us to the next level.
Mm. For me, when I order pizza, I always ask for it to be in 8 slices instead of 12 because I can never eat 12 slices. So that concept there that you explained to me is kind of complicated. Michael, I think your time is up. I know we have to go here in a couple of minutes. Anything that we're forgetting to ask you here at the end?
That was a lot of fun. Love to do it again, guys. Really good questions. It's really fun talking with a couple of resource stock investors and you really clearly understand the space. So I'd love to come back and talk to you again.
Thank you so much for investing your time in us.